Good morning, everyone, and welcome to our fourth call in the Edison Think Tank series. I'm delighted to be joined today by Dr. Jim Walker, Chief Economist at Aletheia Capital, and Mike Kerley, Trust Manager at Henderson Far East Income Trust. So we're all aware that income is under pressure throughout the world. We know that yields are significantly under pressure. Today's Financial Times, Bank of England is pondering negative rates. We see it in treasuries, we see it with Shell, BT, banks in Europe are being directed to cease paying dividends. The same is for US corporates, where they're being directed not to pay dividends, not to engage in buybacks. And then I look at Henderson Far East Income Trust, and I see a yield exceeding 7%. So I said, this is a good time to get Mike Kerley on a call to discuss Henderson Far East Income Trust, to see what is actually going on within his trust and how it's managing to achieve those types of yields. Sticking with the Financial Times, there was an article just recently this week, again discussing Henderson's, and they're just highlighting that historically dividends account for about a third of total returns. And we know that during periods of distress, such as the 40s and the 1970s, that contribution exceeded 50%. So more on that later, but first I'd like to turn to you, Jim, and ask you to maybe share your view on the world and on Asia within your worldview. Thank you.
Thanks, Bill, and morning, everybody. Yeah, it's a kind of distressing headline that you've just read out from the Financial Times, Bill, about negative interest rates, and equally distressing all of the list of things that you had there about the way that government, central banks and everything else are interfering with markets, and the way that companies are either being allowed to pay dividends or actually just perform their natural function. And you actually mentioned the 1970s, and I have a feeling that's where we're going back to in terms of the way that policy is working just now, where we're going to have a pretty nasty inflation shock in the global economy as a result of some of the things that they're doing, but that's for later. Maybe just to give you an idea of where we stand just now and what we've been trying to tell our clients about what's going on in the world just now. Obviously, everybody's stuck at home. You guys are stuck at home, except for people like me in Hong Kong, where I'm in the office and everything seems quite normal. But it's not really that normal, because it's still the case that what we hear outside is the sound of silence. And that's really what we've tried to get over to clients, that this is a downturn that's unique in form, because whenever people talk about recessions in the past and about big shocks in the system, including wars, but what they're always talking about is, to a certain extent, a huge amount of activity, and especially during wartime, where production is going full bung. This whole crisis is about hibernation, paralysis, silence, and it's government mandated rather than a pure feature of the boom-bust cycle. And as such, it requires very different policy initiatives in order to get us through this. In actual fact, in fairness, the UK has done quite a good job here as regards the policy initiatives to take us through the crisis. Because what governments need to do when they have mandated a shutdown is basically support the economy. And that's what we're looking for in all of the government responses that we're measuring just now, whether or not they've actually got the message that they need to effectively pay wages, they need to cut taxes, they need to cut rates and rents, they need to do everything to protect the capital structure, the business structure as it was prior to the crisis becoming the feature of the global economy. And in so doing, when we come out the other end, there might be something left of the economy to get started again. I get very distressed when I see governments that are encouraging people to take on more debt, saying that even if it's partially guaranteed and if it's at low interest rates, that the private sector should borrow more in order to keep going. That's just madness. It's not the private sector's choice that it's shut down just now. So we're always watching to see what's going on with policy and where it's taking us. As regards the kind of future and the way that we expect things to pan out, we think this is the first wave of the downturn. This is the lockdown wave where profits are going to be absolutely decimated in the global economy over the course of the last few months and the next few months. And then we'll go into the second wave, which is an investment downturn, which should last right through 2021, maybe longer. And then we'll go into the third wave, which is the contraction in credit that always follows an investment downturn. And as you'll have noticed, I haven't mentioned any resumption of the virus and any outlook for how the virus acts over the course of the next 12 to 24 months. I think that's irrelevant. These three waves of economic downturn are already set in motion. So our view is that by 2022, maybe 2023, we'll be looking at a global economy recovering.
Okay. And Jim, so that's quite a stark outlook in the short to medium term. So, and in terms of Asia, what's your view in Asia against that backdrop, please?
Yeah, well, you know, the elephant in the room, Bill, is always China, and all of the information that we're getting out of China just now is that things are resuming there. People are back at work, activity is taking place. Consumption seems still to be relatively depressed, and people are avoiding large gatherings. They're avoiding some of the natural areas of consumer demand, that's for sure. And at the same time, there's a big downdraft in exports. So China will, this week and next week, outline its measures for boosting the economy over the course of the next 12, 18 months. It might be one of 3 countries in Asia that gets away with a positive GDP growth this year, purely because it's got such a lot of ammunition in the bag if it wants to in terms of infrastructure spending and the like. But it's going to be a very weak performance from China this year. It might be joined in, as I say, positive territory by Taiwan, which is much more a technology story, and Vietnam, which is the rising star in terms of the manufacturing sphere in Asia. But elsewhere, it's a story of, I'm afraid, negative GDP and really suffering from the effects of export downturn and lockdown.
Yeah, all right, okay, Jim. And Mike, what are corporates saying to you on the ground? What are Asian corporates saying to you right now?
Good morning all. Well, it's a mixed bag, which is not a big surprise. And it varies much by country as it does by sector. As Jim's already said, generally in China, there's a bit of optimism, I would say. So some of the things which were shut down and locked down for certainly the most of March have now kind of started to revive. And we saw the tourism numbers over the Labor Day holidays. Quite big numbers actually started to travel around again. So even the sectors which have been hardest hit, like tourism, airlines, travel, even these kind of areas are beginning to come back. And they're still 50-60% down on where they were, but that's a lot better than where they were, a month ago. Discretionary spending is beginning to pick up. So auto sales are month on month better than they were in March, quite considerably better, but still quite a lot down on where they were year on year. The things which have held up incredibly well, which is not a big surprise and it's happened the world over, anything to do with internet-related transactions or internet-related buying, anything online rather than offline has done incredibly well. Staples, people going out, supermarkets, noodles, these kind of things have all done well, probably, sales actually above where they were pre-crisis. So it's a real mixture. China looks better than most. Taiwan looks better again, and it all depends on how deep the impact was and where these countries are in the stages of recovery from this virus. China and Taiwan are at the forefront. Hong Kong is pretty well placed as well. But you still look at places like Indonesia and India and even Singapore, actually, where you're seeing cases still rise, and maybe we haven't yet seen the peak. So it's a bit like looking at the UK compared to the rest of Europe and where you sit within that recovery phase. But I think on the whole, Asia is ahead of most other Western markets in terms of getting back to normal. And I share Jim's views that there is quite a lot more room and flexibility, both from a monetary side, which I agree with Jim again, I think is less useful, but from the fiscal side, there is also more room as well. Generally, debt to GDP levels in Asia are lower than they are elsewhere, kind of China aside. But so there is room fiscally to get these economies going. And I think the policies that are being used, again, like Jim said, are focused on keeping manufacturing and keeping jobs, because that's the thing that will bring you out the other side, not necessarily giving tax breaks, etc., or trying to get consumers to spend when some of them may not have jobs.
Yeah, it's actually interesting that both of you, both from a bottom up and top down perspective, are in agreement in relation to China and Taiwan. Maybe just on China's response, Jim. Do you think that clearly we've got the NPC coming up, and please, Mike, comment as well on this. What do you think is going to emerge from the NPC? Maybe just to start off with, and then we'll move on to other areas of fiscal response from China.
Yeah. I mean, the first thing really to note, Bill, is that China's response so far, certainly fiscally, has been quite muted. They've introduced a number of measures, they've encouraged a degree of, what would you say, local government and province type activity, where they're being encouraged to issue bonds and undertake a bit of infrastructure spending, but generally it's actually not a very big package. They've done a lot more on the monetary side by improving liquidity conditions in the banking system, by introducing guarantees for certain types of loans, for reducing reserve requirements ratio, for changing interest rates in the terms of some of their liquidity facilities. So that they've, as usual with China, done a lot for the monetary side to be able to jump in when specific types of fiscal policies are enacted. I would say that you're right, that the NPC, I was actually just trying to think if I've got I don't have an actual number at the moment, but I have a feeling that the measures so far in China are amounting to something like 3 to 4% of GDP as a stimulus package. Now, contrast that with Japan at 21% of GDP. Now, more than half of Japan's package, of course, is trying to encourage people to take on even more debt. So it's really kind of smoke and mirrors there. But so far, not an awful lot from China. I expect over the course of the next 7 days, we'll see a huge amount more stimulatory measures being introduced in China, and a lot of them will be concentrated on the infrastructure side, which is going to be quite good news for commodities and for some of the commodity producers, I suspect.
Okay, Mike, do you have any thoughts on the NPC?
Yeah, I think China's learned a lot in the last 10, 11 years. The response to the GFC back in 2008 and 2009 was to basically throw money at everything. And it caused itself quite a few problems in the following years, with levels of debt increasing, overcapacity in a lot of industries, and it basically propped up a manufacturing sector and a state sector which was hugely inefficient, and it massively distorted quite a lot of things over the last 10 years. So I think they've learned from that, which is why the response has been much more measured. It's much more focused on liquidity, which is another thing which I think the Chinese have learned, is that basically over every crisis or every period of uncertainty, basically what you see is pressure on the RMB and pressure on interbank rates. Now, what's different this time around is we've had neither. So Chinese focusing on liquidity, keeping interbank rates low, allowing corporates to borrow and getting access to capital is what stopped the problems in the past with companies running out of cash. And the interbank rate in Shanghai is a great way of showing what the pressure is on companies and cash needs. And actually, it's at record lows. So the Chinese have done a really good job of keeping liquidity in the economy. The next stage, as Jim says, is what happens next to revive. And I think, again, they've learned their lessons rather than just throwing cash at the situation. They've waited till we've got capacity utilization up at the kind of 80, 90% levels in a lot of industries. We've waited till people got back to work rather than throwing money at it, where actually that money would get wasted or saved. You wait till everybody's back at work, in the mood to start consuming, the recovery's starting to take hold, and then you provide some impetus around the edges. And I agree with Jim. I think it will be infrastructure initially, and ultimately they'll like to get consumption moving again. But firstly, it's about manufacturing, infrastructure related. These are great ways of getting money into the real economy very, very quickly.
Yeah, can I just jump in on that as well, Bill, and say that I think Mike's spot on there, and it's a very interesting lesson that China's taken out of the previous crisis. As he quite rightly said, that threw the kitchen sink at it. And, you know, quite literally, China between 2010 and 2013 saved the world. If you look at the amount in terms of increased GDP in dollar terms that China produced over those 3 to 4 years, it dwarfed Europe and the US put together. They have zero intention of doing that again. It cost them too much in terms of misallocation of capital in their own country at that point. And this point, where they're being targeted by certain players in certain other countries, and I don't think they feel that they really need to bail them out this time. So I think everything will be very focused internally, very focused domestically. Now, that's a huge opportunity for investors, given how big the Chinese economy is. But it's going to be a very different approach to stimulation this time.
Okay, that's very interesting. So two things emerge there. One is that, you say dwarfing Europe and the US. Another area where China dwarfs the rest of the world is in terms of its bond yields. Nominal rates are way higher in China than elsewhere. Do you see, both of you, question to both of you, do you see them using that bond market now to attract foreign inflows and using foreign capital? And what impact will that have on the renminbi?
Go on, Jim, after you.
I think you're probably a bigger expert in this than I am, for sure, Mike. But I mean, anywhere that has attractive yields, Bill, and attractive yields combined with an underweighting in global bond portfolios is going to be an attractor of international capital. So in that sense, I think the money flow into China's bond market is at the very early stages, and it's going to be pretty dramatic over the course of the next 10 years. But China's not the only country around Asia that is interesting and probably quite attractive bond yields. Despite all its problems, India looks interesting at the moment to me from that perspective. Indonesia, I think I would probably be kind of slightly avoiding, just because I worry about the health system there. But the Philippines and 2 or 3 others in the region, Vietnam included, are very attractive in terms of their yields. So yeah, these bond markets will attract money. What does it mean for the renminbi? Well, I've listened to so many other economists and things like CNBC and Bloomberg, and I watch the news wires, and I just keep tearing my hair out. No, there's very much to tear out. Sorry, Mike. But the fact is that the Chinese have played this very, very straightforwardly since 2016-17. They adopted a basket currency management approach. And if you look at the renminbi against that basket, rather than against the US dollar, you'll find that it's been pretty well stable for the last 4 years. And it will continue to work against that basket, not against the US dollar. The Chinese actually just don't care about the Americans that much and about the dollar. If the dollar strengthens against all other currencies in the world, the renminbi will weaken against the dollar. If the dollar weakens against all other currencies in the world, the renminbi will strengthen against the dollar. It's as simple as that. And if you watch the basket, then you'll know where the renminbi is going. It's going nowhere.
Yeah, that's interesting. Mike, well, two questions for you, Mike. Do you have anything to add there? And secondly, you know, I look at the S&P. At its lows, it was down 30%. It's now only down 8%. Yet you look at these favourable sort of aspects that Jim and you were mentioning vis-a-vis China. You know, what are you doing with your portfolio at the moment in terms of tilting where you're positioned?
Okay, yeah, sure. I mean, firstly on the bond thing, I don't have much to add either. You know, I think, you know, yields are, well, I suppose it's all related to portfolios and whatever, but, you know, yield is going to be increasingly important, whether we have negative interest rates or not. The interest rates are going to be low for a period of time. And the point of China, well, China has, you know, higher rates than nominal rates than most other countries, and I suspect that will attract capital in the same way that capital will be attracted to some of these other emerging economies. Clearly, at the moment, there's a level of risk aversion. So the question is whether investors can fight that risk aversion in the search for yield. And we've had that in the high yield corporate markets in the US for some time, and that's been a very volatile place to be as people trade off risk appetite against the need for yield. And I suspect that continues. In terms of the renminbi, I think what's quite interesting, as I mentioned earlier, that, you know, in times of trouble, then the renminbi, the difference between the offshore and the onshore rate can show some kinds of stress in terms of the levels of capital that are trying to exit the Chinese economy. But again, that's been notable by its absence. And I think that's partly to do with the fact that the Chinese have done a pretty good job of dealing the capital accounts in the last few years. But also, you know, if you want to take your capital outside China, where on earth do you put it? You know, the world is not what it was. You know, buying London property doesn't look quite as enticing as it once did. And actually, I think from talking to some people in China, that actually the opportunity now is probably better at home than it is elsewhere. So the move to try and move capital offshore to either pick up higher rates, well, there aren't any, to pick up assets, well, asset prices don't look great the rest of the world. May do at some point, but certainly don't at the moment. So again, you know, keeping your money at home where the opportunities are greater is winning out at the moment. So what does that mean for us in the portfolio? Well, you know, yield is key. And I'm sure we're going to talk about sustainability of yield, which is the key point for any income investor at this point in time, especially with what's going on in the UK and elsewhere. But, you know, we see opportunities. We know that earnings are going to be weak this year. It's pretty obvious. But I don't think they're going to be as weak as there are elsewhere. And we do have this lovely gap between earnings per share and dividend per share, which can take up some of the slack should earnings come under pressure. The best opportunities we think are in China. We have 30% of the portfolio in China, a mixture of banks, property, cement, and consumer staples, consumer discretionary, even a bit of technology. And these companies are still relatively attractively valued. And you made the point earlier, Bill, about the fact that the S&P is only down 8%. Actually, the S&P now is at an all-time high in terms of PE. That's quite incredible considering what we're going through at this point in time. I know earnings are depressed, but, you know, prices only dropped by 8. My feeling is that earnings are going to come under pressure hugely in the coming months. And you may well see price come down, but PE continue to rise as earnings fall more than price, which to me worries me as an investor, as an equity investor. I don't see the same dynamic in Asia to the same degree. We certainly haven't got to the levels of valuation that the rest of the world has. And I would say that earnings here in Asia are more resilient they are elsewhere. So opportunity, especially in yield, and we can talk specifically about yield if you like, but Asia generally looks better. Much prefer North Asia over South Asia. I think manufacturing bases, and actually South Asia, I mean, the strange thing is, the irony is, of course, is that everyone assumes that North Asia is more export orientated. But actually, when you look at it as a percentage of GDP, that's not necessarily the case. You look at places like Malaysia, where exports to GDP are way over 100%. It's just that exports aren't reflected in the equity market. So North Asia to us looks a better place to be than South.
Interesting. Yeah, and look, you know, point well raised. I mean, I see Asia trading on 1.2 times book, which is, you know, tracking at a decade low. And you're absolutely right. You contrast it with other markets, more specifically the US. So the other, Jim, you mentioned the elephant in the room earlier on. The other elephant in the room is India. So Mike, I'd love to hear your views on India, and then yours, Jim, please.
Well, I mean, we're income investors, and India doesn't yield. But to be honest, even if I was a growth investor, I'd be worried about India. Well, the valuations are scary, considering the levels of growth. People still seem willing to pay 20, 25 times earnings for growth, which isn't far superior to anywhere else in the rest of the world, in the belief that the quality of that growth is better than elsewhere. I struggle with that. I think India's got some issues. I think the reforms are not happening nearly quick enough. And they're playing around the edges in a response to this coronavirus, which I'm sure Jim will talk about, because Aletheia have written some reports on India following that. But they don't really address the real issues. Some of them are the cyclical response, but they also need structural response. And I don't think they've got that mix at all well, correctly. So I worry about India. I also worry from a more structural standpoint, and everyone talks about demographics being this terrific tailwind for growth, for structural growth going forward. But demographics is only ever any good if you can absorb the growing working population into the economy. At these current levels of growth, when you're producing 12 million new workers into the workforce every year, you've got to provide jobs for them. Otherwise, you risk social unrest, you risk higher unemployment costs, etc., etc., etc. And India hasn't got that mix right. So great, it speaks English. Yes, it has rule of law. Yes, it has democracy. But ultimately, I think some of these structural issues outweigh that, and the market's way too expensive considering the growth opportunities there.
Yeah. Jim, do you have anything to add there from a...
No, not really, Bill, because I think Mike's hit the nail, unfortunately, nails on all of the heads. They went into this crisis in a very weakened position, actually, which was concerning even at the beginning of the year, before the virus was understood to be as bad as it is. And that was partly to do with the fact, and it goes right to the heart of what Mike was saying there, that, you know, this is a government that's promised a lot and delivered very, very little in terms of reforms. It took over in 2014, and basically at that point there was a massive problem in the financial system in India that had been brewing since 2012. There were bad debts building up in the public sector banks, and for 5 years it just failed to address the issue. Kept talking about recapitalisation, kept tinkering around the edges, and by the time we got to 2019, not only was the banking system weakened, but the non-bank financial sector was weakening as well, because they had tried to take on some of the load of the banking system and then built up bad debts themselves. Mm-hmm. So, you know, they were coming into 2020 basically slowing down with an investment slowdown and a GDP slowdown, and now they've been hit by this. To be quite honest, it's literally a government-made problem that they're now contending with. That they should have been growing at 7, 8, 9, 10% a year. Mm-hmm. They were coming into 2020 at probably close to 4, and now hit by the virus. The IMF actually have projected that India will be the fastest growing economy in Asia this year at 1.9%. All I would say is that the IMF have got the sign wrong in that, and it's probably a multiple times wrong.
Yeah, no, fair enough. Okay, so well, look, what I'd like to do now is to move on back to you, Mike. Just two things for you. First of all, I'd like to know why the dividend is so high within Henderson Far East Income Trust, and then secondly, I'd like to know. I think we've touched on it. I mean, Jim and yourself have touched on it this call. Why is Asia perhaps more resilient? Why is Asia different? We know that they've got lower payout ratios. So maybe if you could elaborate on that as the second question, please, Mike.
Yeah, sure. I mean, we have to take into context with that. When we talk about Asia, we're talking about Asia Pacific here, certainly from Henderson Far East perspective. So we're including Australia and New Zealand, and all the way to India and everywhere in the middle. And within that, you've got different countries at different stages of adopting a dividend culture. So Australia and New Zealand pretty similar to the UK, and that's where most of the dividend risks currently lie within our portfolios and the markets in general. Elsewhere in Asia, you tend to find much lower payout ratios, as you said, much bigger gap between earnings per share and dividend per share. So payout ratios in Asia are around about 35%. So earnings can come down quite a long way before before you necessarily need to see a dividend cut. So that's the first thing. The second thing is that companies do not have much debt, unlike the US, where you've seen corporate debt being built up over the years in order to buy back shares, which has been great for earnings. How people have fallen for that scam, I have no idea, but it has happened. That hasn't happened in Asia. Generally, corporates are cashed up. There's more companies now, with similar numbers of companies who are net cash as net debt. And that obviously gives you a nice backdrop as well for shoring up dividends. And the other thing is the adoption of a dividend culture, which I think companies are finally beginning to realize that actually dividends are as important as earnings. And actually, in this environment of low interest rates, you are seeing share price reaction to dividends is actually a stronger reaction than share price reaction to earnings. And the reason for that is that dividends is a much more forward-looking announcement. Earnings generally are 1 year guidance and the rest of it's historic. Whereas dividends, if a company says, okay, well now we're going to take 30% of our profits and pay you as dividends, it's going to be 40%. That's not just 1 year, that's an ongoing obligation to share the profitability of that company with its shareholders. And as a result, rightly so in my opinion, the market rewards that. Management are beginning to see that, and as a result, management do care. Obviously, they're invested in their own companies as well, do care about share price performance, and they begin to realize that the power of dividends drives share price. So that again is a cultural change which we're still benefiting from in Asia, which maybe has probably been and gone elsewhere.
Okay, excellent. And specifically on your fund. Are there particular investments you're making to achieve that in terms of options, strategies, etc.?
Yeah, we use two types of companies. So basically, the portfolio is split 50-50 between high yield and dividend growth, and we supplement the dividend growth part of the portfolio with the use of options. The reason why we do that is because it means I don't have to own high yield stocks that I don't like because I have a different revenue stream. It also means I can buy companies with lower yields in order to get that dividend growth, that cultural change, which is a capital event, not just an income event. And we use options very selectively around the edge of the portfolio and around the edge of our target prices, selling put options and call options. So to give you an example, if we've got a stock in the portfolio we think is fully valued 10% higher, then we will sell a call option matching that strike price of that option at the price we were willing to sell it at. So the core of what we do is valuing the companies. And if we can make money out of making normal investment decisions around those target prices, then we will do that. We want to be as income efficient as possible. And that supplements the income in the portfolio, which is about 5% portfolio income, give or take. And gets to pretty close to our distributable yield, which is, as you say, currently north of 7.
Yeah. certainly very attractive, Mike. I tell you that.
Yeah, especially when you can't get any yield anywhere else. 7 looks a bit common. I agree.
Exactly. Okay. So look, before I move to Q&A, is there any sort of final comments from either one of you you'd like to make?
Not from me. I'm interested to see what other people want to discuss, really, rather than me rambling on.
Okay, so look, if anyone's got a question, please, if you could raise your hand. If I could ask people to keep it to one question, just to start off with, because we've got a few questions coming in. I'm just going to start with one question we got from David Staples. He's saying, Jim, why do you think inflation will be a 70s problem when 12 years after the global financial crisis, and with all the monetary stimulus that we've seen, that we haven't seen any inflation yet? It's all been deflation.
Well, it hasn't all been deflation at all. It's been massive inflation, but it's all been in asset prices. That's the only difference. The whole system was set up with central banks, QE, and with going to zero interest rates to support asset prices, to pile money into the banking and the financial systems. And that's where it stayed, and that's where it's boosted prices. But to say that there's been no inflation is, I'm afraid, just completely wrong. There's been no consumer price inflation, that's for sure. And that's where the big difference now lies, because the response to this crisis has actually been much more fiscal, and had to be much more fiscal than really monetary, in the sense of central banks supporting asset prices. There's going to be an awful lot of government debt increase over the course of this year and into 2021 and possibly into 2022. That government debt's going to get into businesses, and it's going to get into the pockets of unemployed people and employed people. Now, here's where the real danger begins, because as aggregate demand goes up under those circumstances, and supply doesn't respond, and supply won't respond, for one very simple reason: there's a lot of sections of the economy that are now closed off. Tourism, international tourism, isn't coming back in 2020, 2021. Big sporting events isn't coming back 2020, 2021. The same is going to be true for entertainment, for restaurants, for possibly pubs and clubs. So there's going to be a shutdown of certain areas of supply, but no shutdown in areas of demand. So the more you've got monetary demand out there faced with less supply, the more consumer price inflation you get. And that's what the 1970s and 1980s were about. So almost exactly the same combination as the 70s and 80s when you look at the fiscal expansion and the monetary expansion that's taking place together this time. Whereas with the crisis in 2009-10, the fiscal expansion was reversed very, very quickly.
Yeah. So crucially, do you see the asset price inflation that you've seen in the last, obviously, post the global financial crisis? What do you see happening with asset prices this time around, in particular in an environment of, as we saw today, discussions of negative rates?
Yeah, well, you know, I'm bang there with Mike when it comes to things like the S&P 500. You know, if price stays the same, I would think that the PE ratio is going to double or treble over the course of the next 12 months. So that's without a single bit of movement in the stock market, because earnings are going to collapse. That's all.
In property, Jim, residential property?
Yes, very, very low. And that usually encourages people to buy property. But again, you know, you're in a much more difficult situation just now, with the way that people will either move around or be able to move around, even within economies, never mind between economies, over the course of the next couple of years. So I suspect that real estate property prices are actually going to be relatively subdued over the next couple of years.
Okay.
I think that just the big problem is that with interest rates where they are now, that they're doing much more damage to the global economy than they are in terms of doing any good. And that's largely because of zero interest rates tell you that one thing is happening in the countries that have got zero interest rates. There's no growth coming down the line. And when there's no growth coming down the line, companies don't invest, businesses don't expand, and economies don't grow. We're basically heading towards a Japanese, globalized Japanese world, where places like the US and Europe are just going to follow the Japan model, and if they're lucky, they'll get 1% nominal GDP growth for the next decade.
Yeah. Okay. Okay. And
I like to be upbeat, though.
Yeah, exactly. So, Mike, just a question for you. It was me that raised it sort of 1.2 or 1.3 times book, but Alex Ferguson's asking, is that being warped by banks' price to book ratios, given that they're so low?
It is to a degree, because banks make up a large part of the index, and the Chinese banks in particular trade at 0.5, 0.6 times book. So that is going to have an impact. You're right. I suppose the question is how much of those book values are at risk in the banking sector, if we want to use that as an analogy. And to my mind, I don't think there is any risk in the book values of Chinese banks. I think there is in the things like Australian banks. I think there is probably in other banks where they might be called into national service. Korea is a prime example of a government that's likely to interfere in the corporate sector, and especially in the banking sector, to make sure that banks extend credit to maybe people that really don't deserve it. But from an index perspective, the big sector, as I say, is Chinese banks. And I think when you need to look at Chinese banks, you can't compare them with things like HSBC or Barclays or Citibank, et cetera, et cetera. When you look at the Chinese banks, what you're actually looking at is Chinese sovereign debt. Because these banks are run by the government. Okay, yes, they lend to SOEs, and you could argue that some of those SOEs probably don't deserve the capital. But ultimately, those state-owned enterprises are owned by the same people who own the banks. So you just move the money around the economy. In a capitalist society, that would probably be done centrally. It will be done at the centre, and hope that the private sector passes the doctrines from the centre down to other parts of the economy. And I think, as Jim will probably agree, that hasn't happened in 2010. Government policy has never made its way into the real economy. And as the point I made earlier about companies taking low levels of interest rates, borrowing more, buying back shares, and boosting EPS has done absolutely nothing for the underlying economy. In China, what tends to happen is the governments decide which way the money should be spent, and the banks act on the government's behest. So I don't think there's a risk. Personally, I think non-performing loans will increase in China, but not to the levels which we would see elsewhere. They're currently only about 2%. They may double, but in the scheme of things, considering the levels of provisions that the banks currently have, I see no risk in the significant deterioration in book value. So even when you look at price to book and say, well, is it distorted by the banks, and the banks are about to have their book values carted, I don't think so.
All right. And have you looked at, if you were to X out the banks, what sort of price to book would, just roughly, where would that get you to, if you were to X out?
Using a very simple calculation, that basically, as long as the banks earn in return equity more than their cost of equity, then they should be at book value.
Okay. Yeah.
I mean, that's a very simple way of looking at it.
Yeah.
At the moment, their return on equity is about 12%, and the cost of equity is about 7%. So what that tells you is that effectively the market doesn't believe that these banks, doesn't believe the book values for a start, and doesn't believe that those book values won't deteriorate. In a worst case scenario, maybe you get 5 or 10% decline in 5 or 10% non-performing loans. In our estimation, we think that the market's currently pricing in something in the region of about 8 to 10% non-performing loans. That's why you get 0.4 book. I mean, 0.5 book and 12% return on equity. My God, everyone should be going out and buying these things like there's no tomorrow. But clearly there's underlying disbelief in some of those numbers. My feeling is, and we like the Chinese banks, my feeling is the market's mispriced these.
Yeah, okay. So if Aldrino's on the line, if you wouldn't mind unmuting, there's a few people that would like to ask questions live, Aldrino, if you wouldn't mind unmuting them so they can ask the questions, please.
Sure, Bill. The first question we have is from Joe. Joe, you can ask your question now, please.
Okay, just a question in terms of Hong Kong, Jim, in terms of politically. What risk do you see to the current presidency in China in the context of what's been going on in Hong Kong for the last 6 months?
What risk to President?
Yeah, staying effectively as president.
Yeah, I don't think there's very much risk to Xi as regards Hong Kong. Quite simply, the most mainland Chinese don't care what's happening in Hong Kong. They think it's a spoiled brat anyway. If anything, they harden their attitude towards Hong Kong rather than worry about President Xi's position. So, I mean, if you were asking me, do I think that things are going to settle down in Hong Kong, I would say to you, no. It doesn't look like it at all at the moment. There's actually protests happening now, even though there's still the restrictions on the number of people that can gather in Hong Kong, restricted to 8. And that's round a table, but that's not stopping them actually protesting again. I don't think there's any risk to the stability of China from Hong Kong, quite the reverse. I do think there's a risk to Hong Kong.
Great, thanks, Jim. Jim, I've got a question from Singapore. Could you, as an interesting one, could you comment on the potential impact on sentiment from delisting of some Chinese ADRs by NASDAQ, and also the restriction on IT component supply chains to Chinese companies?
Yeah, well, the first thing to say about the delisting of potentially Chinese ADRs in the US is that the Hong Kong Exchange is out of the box already today, making representations to them to list in Hong Kong. So, you know, this is undeniably yet another positive from a Hong Kong business perspective, that Alibaba is already here. The exchange is going to make a play for more people to move over if they possibly can. I think for a lot of the Chinese companies, especially the technology guys, they're actually already in compliance with the requirements that Senator Kennedy was outlining that are required now for remaining listed in the United States. And remember, it's going to take 3 years before this would actually come into operation if there was delisting. But yeah, Hong Kong's going to make a play for more people and more companies, no doubt about that, and it'll probably get some. Yeah. In fact, I don't think the Chinese will be that worried about transferring, given the lead from Alibaba. Sorry, what was the second part of the question, Bill?
The second was, restriction on IT component supply chains to Chinese companies.
Yeah, well, of course, that's a lot more serious for Huawei, obviously. I mean, I don't follow the companies that closely, but Huawei actually, and maybe Mike, have you got more knowledge of this one?
Yeah, I think this is sadly, this is the way that the things are going to go for the foreseeable future between the US and China. The supply chain is split really, because obviously there's Huawei is a big player in smartphones, in telecom infrastructure, and obviously the supply chain that supplies Huawei, you could make a list of the best and worst performing stocks in the supply chain depending on how much exposure they have to Huawei. So at the moment, it looks like the Americans are trying to squeeze out Huawei completely. But this, to be honest, this doesn't happen for 120 days. So you're going to get this kind of strange effect for the next 120 days, where Huawei will be building up inventory like there's no tomorrow. So you're going to get this kind of false dawn, where the supply chain will do really well as Huawei inventory builds, and then obviously that demand will fall off the cliff 120 days down the road. And then you have to look at, well, who are the beneficiaries? Well, people talked about Samsung, obviously smartphones, so other national smartphone companies, Samsung, Apple potentially. But then you think about, well, if the Americans have gone after Huawei, what do the Chinese do about Apple? And it's this tit for tat arrangement, which I really do hope doesn't escalate, but I fear it probably will, especially into the US election in November, that the Chinese start either through going down the nationalistic route and saying that basically the US is after us, buying US products isn't in the national agenda. You know, they did that with Korea and Japan in the past. It's very possible it could happen with the US. And then you look at who are the beneficiaries of that? Well, ultimately no one, but there's clearly some losers out there. So the supply chains is in a bit of a mess. There's only a few things I think we can gain from this. And the important thing is the fact that the longer this goes on, the more China will try and be self-sufficient in a lot of products which it currently needs the US for. And that's mainly semiconductors. China imports more semiconductors than it does oil in terms of value. I mean, that's a big, big number. And they'll try and address that as quickly as possible. So some of the companies which, like MediaTek is an example, which is a chip manufacturer, competes with Qualcomm in the US, Taiwan-based. You know, this is a company which is benefiting from that trend. And there's others out there. I don't own MediaTek, so I'm not pushing a company we own, just for a matter of interest. But, you know, there's companies like that which benefit from this self-sufficiency trend.
Okay, that's an interesting statistic in terms of importing more semis than oil. Another question from London here. Mike, are you seeing Asian companies reduce dividends?
Some, yes. What I didn't mention earlier and should have done. There's a dynamic that happens in Asia in terms of dividends, which means that some of the impacts from coronavirus we won't see this year, but may well see next. So some markets, Hong Kong, China, Taiwan, probably the main two, only pay dividends once a year, and they pay it with a bit of a lag for the end of the financial year. So Taiwan, for example, pays most of its dividends once a year between June and August, but they're all based on FY19 earnings. So there's a lot of the companies which announced these dividends in March and April this year, which will pay in August, are unaffected by coronavirus. So actually some of the yields look quite attractive. The prices have come down. The dividends are based on last year's earnings. You know, for a yield investor, that's quite attractive. The yields look very high. But obviously that does ask the question about what happens next year when we get to the same point in the year and the Taiwanese companies and the Chinese companies start announcing dividends based on FY20 earnings, which, as we expect, will look a whole lot worse than FY19. So for these two countries in particular, the virus impact is a 2-year phenomenon rather than a 1-year. I mean, it may well end up being a 2-year phenomenon for the rest of the world for a different reason, but for these countries in particular, dividends, you probably need to look at 2-year to get the overall effect. For that reason, we've actually seen companies raise dividends. Quite a lot of companies raised dividends this year because FY19 wasn't a bad year for earnings. So we're actually seeing some uplift. The markets where there is downgrades are Australia and New Zealand. Generally, they pay half yearly or quarterly. So you see much more impact on dividends in a more timely fashion. Actually, more than 70% of companies in Australia have cut or reduced dividends. That's a big, big number, far higher than it ever was in 2009. So the risk is clearly out there, but it is focused on the sectors which I mentioned earlier: transportation, energy, financials, consumer discretionary. If you're avoiding those, which we do, then actually we're seeing a mixture of some where a little bit of, haven't seen anything dividends cut in our portfolio. Some were maybe a little bit more disappointing than we'd hoped, but we're also seeing companies pay out more than we expect. So it's a mixture.
Okay, interesting. Okay, Aldrina, we have a question from Bernard. If you wouldn't mind opening it up to Bernard, please.
Sure, Bernard, you can ask your question now. Bernard, you're currently muted.
It's showing muted for Bernard.
Yeah.
Excuse me. Can you hear me now?
Yeah.
Yes, we can.
Yeah, sorry, guys. Thanks, guys. Very interesting presentations all around. I have a question specifically for Michael on Chinese equities from the perspective of a long-term investor, because we've got, it's very tempting. We've got good growth, good earnings growth, lower valuations, and we've got low payout ratios that, if it all works out over the longer term, as China matures and these companies mature, we get that money out in the form of dividends. That's how we finally get the real return out of China. So the big risk is, I'm just wondering how you deal with this and what way you can advise us on this. The big risk is that's not how it works out, that over the long run, we find that Chinese equities are run for China society. Not as in the US, where we've probably got the best example of an equity market run consistently for shareholders specifically. So do you think the risk is significant that that's how China works out in the long run, more like Europe or even worse again?
That's a really good question. But I'd take point with the fact that the US market is run for shareholders. I don't think it is. I think it's pretty obvious what we've seen. The people who've made the most money out of the US equity market, all right, the shareholders have done pretty well, but senior management's done a whole lot better. So I would argue where the impetus lies in some of these senior management. And to be honest, we've seen this. Inequality's risen. You look at, across the world, inequality's risen. But you look at cheap executive officer pay in the US market in particular, and it's gone through the roof. Now, obviously as a shareholder, you benefited from the share prices going up, but ultimately, executive pay is a cost, which is absorbed by shareholders. So I think you need to have a little think. And at the moment, the market's not really focusing on it because the share prices continue to go up. Well, does it really matter? We all benefit. But I think in the years to come, in the months to come, we'll start looking at some of the actions that have been taken by corporates globally, not specifically in the US, but and whether that's been in shareholders' best interest.
I couldn't agree more, Michael. I think it's fraud the way executives are paid in the US. But the thing about this is, even the most fraudulent fat executive in the US or group of executives, they can only dilute shareholder value so much by becoming ridiculously wealthy themselves. But the bigger risk is society. The company is run for society, which is a much bigger potential dilution. And as I say, China's going to work out more like the US or more like Europe or worse than Europe in that sense. And that's where the big hit comes.
Yeah. No, I understand. And I was going to go on to say that, China, clearly, if we think that the Chinese state-owned enterprises are run for shareholders, then we are mistaken.
Yeah.
I think when you invest in China, you have to be fully aware of what the risks are and what the emphasis that the Communist Party has. Now, the Communist Party ultimately wants the Communist Party to stay in power. That's the ultimate goal. And in order to do that, they need to ensure that the economy grows at a certain level. There's no social unrest, which means there's little or no unemployment. The thing that keeps the party in power in continuity is a healthily growing economy. And that's ultimately what they'll do. Now, the state-owned enterprises ultimately pursue the government policy. Now, when you're investing in China, you need to be aware of this. And we've done quite a lot of work on governance and the structure of boards and the structure of management in China. And to us, it's really, really important to make sure you invest alongside the government rather than against the government. And that doesn't matter whether you invest in private companies or state-owned companies. Anyone that says that Alibaba is a private company is wrong. Alibaba only exists because the government lets them exist. Now, whether the management's actually from the government or it's a private enterprise, it doesn't matter. Government policy is all-encompassing. So for us, it's really, really important to look at the quality of management, the objectives of the company, and whether they sit alongside government policy. Now, the Chinese give us a hand here because they come out with a 5-year program. And unlike other politicians, which come out with manifestos for elections and never stick to them, the Chinese 5-year plan, they stick to it. So you can say which industries you know which industries they're going to favour. They know where money's going to be invested, and as a result, as an investor, you should be investing alongside in doing that. So the point I'm trying to make here, for an investor in an income fund, now we care about governance. Dividends and governance go hand in hand. I want to be in the industries which the government favours. I also want to be in industries where the government actually needs the money out of the companies in the same way that I do. You know, a lot of this investment is going to be funded by companies paying dividends back to their parent. I'm happy to invest alongside the government doing that. Now, are we going to get, one day we're going to wake up and China's closed and we're going to lose all our money? No, that's not going to happen. Chinese needs the world, China needs the region, and China needs capital, foreign capital, and will do for a considerable time yet. So anything that adjusts the need or the attractiveness of China as a destination for foreign capital, the Chinese will not engage in that. So that's why I don't think the risks to capital are great in China, or certainly no greater than they are in most other markets around the world.
Thank you.
Okay. Thanks, Bernard. So another question is, what for Jim this time, is 1% nominal GDP growth consistent with higher inflation?
Good question.
That's from Ronan O'Houlihan, by the way.
Ronan, very good. Yes. Not in the long term, obviously, but you know, if I were to say to you that in 1975, the US was experiencing 12.5% CPI inflation. You might be surprised to know that its real GDP growth at that time was -2%. And then in 1980, when it was at 15% inflation, real GDP was also negative. Now, nominal GDP was higher, but I wasn't actually trying to suggest that we were going back to 12.5% or 15% inflation. What would be catastrophic for the US economy and essentially for Europe at the moment is if we went back to anything like 5% inflation. Now, could you get nominal 1% growth with 5% inflation? Very easy. But if you did get 5% inflation, you could be almost guaranteed that you're heading towards 5% interest rates. And with the level of debt and the level of zombie companies that we've got out there just now, that would be catastrophic. You know, the IMF actually produced a document in October last year where they were looking at what would happen to corporate debt if we had a crisis half as bad as the global financial crisis in 2008-9. Now, we're actually in the middle of a crisis that's going to be twice as bad, not half as bad. But their projections only 6 months ago were that would produce $19 trillion worth of bad debts in the big 10 countries, sorry, the big 8 countries of the world. And 40% of corporate debt would be at risk in the sense that it wouldn't be covering its interest costs with its earnings. And that was with a crisis half as bad as the global financial crisis. So can you imagine the kind of carnage that would occur if interest rates actually rose as a result of government policies over the course of the next 2 or 3 years into that kind of debt environment?
Yeah, I guess begs the questions for another call, but I mean, who knows with the levels of intervention that we're seeing by central banks and governments worldwide, you know, will there just be simply attempts to suppress the yield curve, Jim? But,
oh no, there'll definitely be attempts to suppress the yield curve, and they've done it before, Bill. The big problem they'll have at that point is that they'll end up owning all the assets in every market that they're operating in. There wouldn't be any markets.
Yeah, yeah. Well, okay. So we've got. So look, I've just time for possibly 2 more questions. So I've got two questions that kind of related, and I think we touched on it earlier. So if you've anything fresh to add on to this, one is, do you see, either of you see deglobalization as a threat to corporate earnings? And then the other question is, can you both comment on the new Cold War? But really, we'll give answers to that brief, because just in the interest of time, because we're about to wrap up.
Okay, well, just deglobalization, I think it'll happen in the short term, but ultimately we'll go back, is my feeling. In the short term, you know, all policies are going to be, I mean, whether this is all about, you know, deglobalization and the move for deglobalization in the last year or two has all been based on the fact that manufacturing capacity in a lot of the major countries around the world has been lost to low-cost manufacturers elsewhere. And that's caused social issues, political issues, and blah, blah, blah. But where we are now, my feeling is that continues, but for a different reason. And the reason being is that governments are going to be supporting domestic industry and domestic manufacturing. So in the same way that exports have been king, domestic manufacturers will be supported in the short term. And that in itself will lead to a level of deglobalization. You know, when you have low levels of capacity in manufacturing domestically, you're not necessarily going to be using manufacturing elsewhere to supplement. But you know, when that recovers and when we recover, utilization levels rise again. I suspect wages pick up more here than they do in some of these low-cost manufacturing areas, ultimately, especially as capacity becomes tighter. And then we go back to the fact that ultimately, you know, low-cost goods and low-cost manufacturing is beneficial in supply chains and corporate earnings going forward. So short-term dynamic change, but probably continues, but ultimately globalization returns, assuming we can get through some of these social and political issues. I don't know what you think, Jim.
Yeah, I kind of agree with that, Mike. I think not so much deglobalization. There's certainly going to be a change in the supply chain structure globally, and that's not just to do with America and China's disputes, but it's actually inevitable anyway, because China's getting much more expensive. Other parts of the emerging markets are getting much cheaper, and China doesn't want the low end anymore in manufacturing. Plus, it's going to become a much more consumer-driven economy itself. But as far as the whole kind of deglobalization from a politics perspective goes, as I keep trying to say to our clients, governments make nothing. Governments trade nothing or exchange nothing, and governments are basically good for nothing. So, you know, the fact is that it's consumers and businesses that actually drive globalization and the structure of the global economy in terms of where to access things, where to put manufacturing and where to do business. Thank goodness for that. And I think Mike's right, politics can get in the road for a wee while. But there isn't going to be deglobalization. There's going to be continued globalization because it suits everybody best that that's the case.
Okay, very good.
The other one was Cold War, wasn't it?
Cold War, exactly. Yeah.
Well, I mean, it's really tough. You know, I really hope it doesn't escalate, but you could see a path where it could go down. And the relations between the US and China will be fraught. I mean, I think it's fair to say that China won't start anything, but they may react. And some of the stuff that's coming out of the US, and I don't know if you've seen some of these YouTube publications of various demonstrations, etc. I mean, I think it's 66% of the US population is anti-China coming into a US election, so it's pretty obvious which way the politicians are going are going to go as we go over the next 3 or 4 months. And Huawei is probably an easy target. I suspect that the trade, part one of the trade pact will probably be unwound in the coming months and weeks. So the chances of getting a serious trade deal done anytime soon are probably remote. And then I just hope we don't go further. There's talks about the South China Sea and some of the US ships traveling through, US warships traveling through the South China Sea. And that's when it starts getting a bit scary. I hope we don't go there, and I hope this is just 4 or 5 months. We go into November, and obviously then it passes. But there's always a risk that mistakes are made.
Yeah, I think that's right. But we've already heard, I think overnight, about the coronavirus playbook, which is basically Trump's playbook for winning the election in November, and that's just going to be blame China, blame China, blame China. Interestingly, 60% of Americans, unlike the 66% that are anti-China, 60% of Americans seem to want to work with China to find a solution to the coronavirus problem, which is kind of like when you do polls about, do you want to pay more taxes? No. Do you want government to spend more money? Yes. But it's worrying that it's happening in an election year and that this virus is around, and it's a blame China virus, because that just plays into Trump's hands. And I've got to say, the one thing that worries me more than anything, and I hear what Mike was saying about the warships going through the Taiwan Straits and the like, but the real danger is that if the US entices TSMC or other Taiwanese companies to relocate to the US, China will take that as an act of war. And the biggest danger there, I would say, is an invasion. Not hitting US warships, but just going into Taiwan. And I think that's probably risen in terms of danger level from less than 5% to certainly between 15 and 20 at the moment.
That's interesting. On that point, TSMC opening a plant in the US, is that a big issue, or is that just...
That's just another plant, Bill. It's as if it would be much more the case if it was relocating completely.
Yeah.
Then it would be a disaster.
Yeah, you don't see this as being any sort of part of that kind of appeasement to the US, or?
Oh no, definitely it is. But I don't think the Chinese will go nuts over that. They've got plenty of plants in the US themselves.
Yeah. Okay. So I've two kind of related questions, and then I think we're going to aim to wrap up. One is, have you seen, Mike, has there been a recent sell-off of any major position in the portfolio? And then a related question, what have been the best or worst parts of the portfolio year to date?
Okay, well, I'll answer the second one. The best parts of the portfolio is anything we sold before February. So the best parts of the portfolio have generally been Chinese shares. So anything exposed to, we've had a feeling for a while that supply side reform in China will be very beneficial for some of the companies that operate in some pretty rusty and dusty old industries. So cement, for example, where cement prices continue to go up almost irrespective of the virus, and certainly were going up through last year. The pricing discipline comes into that market, and the demand for cement still remains pretty decent. And some of these companies have done incredibly well for us. We've also found that consumer stocks have done well, so sportswear companies. And we also had a belief that if you're going to buy consumer stocks in Asia and consumer brands, you want to buy Asian brands and not luxury overseas brands. That ultimately, over time, domestic brands will rise in popularity at the expense of foreign brands. And I've always believed that if you owned, I don't know, Louis Vuitton or something as a way of buying Chinese demand, that actually you're kind of missing the point. The same with things like Nike and stuff like that, because Nike's doing well in China, but the local brands are doing better. And ultimately, local brands will do better. So things on that theme, local brands over foreign brands, stateside enterprise reform have also been doing well. And we've also had a belief in property across the region. Well, obviously with interest rates being low, that helps. And there's obviously high yielding property sectors and REITs, etc. That hasn't worked quite so well because of some of the rent holidays that some of these REITs have been giving. And changes to the portfolio, the biggest changes we made really are ditching banks across the board, which we did in around February, March. Some of it too late, some of it we timed quite well. We don't own any Australian banks at all, which for our yield fund is highly unusual. Well, we own Macquarie, but that's a commercial. That's not a commercial bank. It's a more of an investment bank. So we ditched banks in Korea. We ditched banks in Singapore, in Hong Kong, Indonesia. So across the whole of the portfolio, we took banks out, and that was in the belief that obviously interest rates are negative, net interest margins will fall. And although normally when interest rates fall, you get the offset is that maybe you get more loan growth, but you're not getting that in this environment. So all you get is lower profitability. And there's always the risk of national service, which means you have to lend to people you don't want to. So non-performing loans down the line. So banks for us is very low. The only ones we still own are the Chinese banks for the reason which I talked about earlier.
Yeah, okay. Yeah, it looks as though banks are unloved in most jurisdictions in the world. Okay.
Well, it doesn't matter where you are in a cycle, they underperform.
Yeah. Yeah.
You just look at if you look at how the last 4 months have gone. We had a peak in January, markets fell a lot, and you look at the sectors that fell the most, and generally a lot of those sectors then bounced again when we had the rally. And you look at the list, and the worst performers on the way down, bottom 3 banks. Worst performers on the way up, bottom 3 banks.
Okay. Well, on that note, I don't know, Jim, if you've got anything finally to say?
No, I'm good, Bill. Thanks.
Super. Well, look, I'd like to thank you both for a really illuminating call. Yeah, we covered a huge amount of ground. I personally found it very interesting. There still are some questions outstanding, so clearly there was also a lot of interest in what you had to say. So thank you very much once again, and thank you to everyone for joining us on the call. Once again, thank you for those who stayed up late in Singapore, or in late in Singapore, and you, Jim, working after hours in Hong Kong too. So we look forward to seeing you all again on our next call. Thank you very much.
Cheers, Bill.
Thank you.
Thanks.